We're going to talk about the latest trend that is going on inside of pension plans across America. And not to get too far ahead of ourselves, but it's not a particularly good trend, but it's one certainly that you're going to want to know about if you have a pension coming to you, or perhaps maybe you are receiving a pension from any number of public or private pension funds out there today. We welcome you to the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life with a successful and cost-effective financial plan. So I hope you all had a good Thanksgiving. Last week on the show, we gave you some statistics on the amount of injuries that can happen when folks fry turkeys at Thanksgiving. Needless to say, we were able to successfully navigate not burning the house down this year once again at my house for Thanksgiving. So hopefully you all had a good Thanksgiving. If you watch the program on YouTube, you know then that if it's post-Thanksgiving, it must be Christmas holiday tie time. So we're sporting our Christmas holiday tie. And of course, doing that now simply means we're like a month behind every other retailer out there because they certainly had those in. I think in some cases they had some of that stuff in before Halloween. So anyway, we are off to the races, should we say, because of the holiday season now officially be in front of us. So we are certainly in that home stretch. So one of the things about this home stretch in this December, or should I say the last of November, really more as we're looking into December, is that this time of year are when mutual funds typically distribute out dividends and capital gains. And that's just something that typically happens particularly at year end. Now, some funds will distribute out along the way. Maybe they'll do quarterly dividends. Maybe they'll have a mid-year special capital gain distribution or something like that. But the bulk of it, 90%, maybe even 95%, happens between now and the end of the year. So what do we mean by that? So what happens inside of a mutual fund during the course of the year is that it owns a bunch of stocks. And so those stocks will pay dividends. Maybe there's some selling of individual companies inside the portfolio, which means then that is a recognized capital gain. Well, all of that activity, whether it's dividends that a company pays or some internal sales that generate capital gains on some of the positions, all of that then has to get distributed out proportionately to every shareholder of that particular fund. Now, more often than not, most people just wind up reinvesting that directly back into the same fund. So it doesn't really necessarily change anything, except for the fact that there is a little bit of change between sort of the record date and the payable date. Because what's happening there is that as those dividends and capital gains that are sort of internal, that profit, if you will, that comes from a dividend or a capital gain is priced into the existing share price of that fund. And so what happens is then when those dividends and capital gains ultimately get paid out, what you will see is that the price per share actually goes down, representing the payout of those dividends and capital gains, and then your number of shares will increase in that fund, because at the end of the day, this is not a transaction where you're like losing money or anything like that, but it really is just the notion of having those dividends and capital gains pay out. Those dividends and capital gain amounts are already reflected in the price per share of the fund. So in order to kind of pay those out, if you will, then the price is going to drop because the amount of that is already priced into the fund share. And so consequently, when those get paid out, the fund price will drop, those funds that get reinvested. At the end of the day, your total value doesn't change, But say, for example, if you're tracking it on like Quicken or Yahoo or whatever the case may be, and you're really specific on how you've put that information into your spreadsheet, and you're only using number of shares, well, you're going to want to update those number of shares. Otherwise, on that payable date, you're going to see like, oh my goodness, I lost a bunch of money in this fund, and yet, that didn't really happen on that particular day in the market. What happened? Well, what happened there is that payout of those dividends and capital gains. Now, if you own a retirement account, from a tax perspective, it doesn't really matter. All that really matters is keeping your number of shares, if you're tracking that, up to date. So that's why it's important to know that this time of year, the dividends, capital gains, things like that, you actually get paid out. But where it does come a little bit more into play is on non-retirement accounts, because those dividends and capital gains are in fact taxable and do generate income items that you're going to have to report on your taxes. So here's where it gets a little different, if you will. Retirement accounts, if you got a retirement account, mutual funds inside a retirement account, none of what we're going to talk about right now really has anything to do with that, because all of that then winds up getting reinvested. And at the end of the day, everything inside of a retirement account is going to come out as taxable income, ordinary income, as you take money out of that account. But on a non-retirement account, think of a individual account or a joint account that you may have with your spouse, or a trust account. Any of those types of accounts are generally viewed as after-tax accounts. So what happens with those dividends and capital gains is that you're going to wind up having to report those on your tax return. Now, good news on that is that for the most part, those dividends and capital gains are taxed at preferential tax rates, because we know that there's a different tax rate that applies to qualified dividends and capital gains, and that rate is like 15% or even 0%, depending upon which bracket you're in. It's actually a little bit higher rate for capital gains and dividends, and the really high income brackets that could get that to 20%. But regardless, those rates are still a lot less than what it is that you would have to pay if it was an ordinary income item. So that is going to happen inside your portfolio. And I guess the good news on that is that those dividends and capital gains are still taxed at those lower rates. The bad news, and this is particularly true for this year, is when you have a year where the market has done well, like this year, what happens is then that you wind up having an increase in those dividends and capital gains. And the reality is that when you kind of look at some of the preliminary estimates, those increases for this year amount to, in some cases, almost 30% or more increase over prior years. So that's kind of the bad news in a way. Again, good news, bad news on that, right? It means that you had a pretty successful investment year, but it also means then that you've got more things to report on your taxes and pay on your taxes. So first and foremost, be aware of that potential tax hit. But there's also something to be aware of as well when it comes to the diversification and what you might be able to do with those dividends and capital gains. So we're going to take a break. When we get back, we're going to continue this conversation of this dividends, capital gains, payout, and reinvestment, and what you should be doing and be aware of in particular over the course of the next 30 days as that happens with your after-tax account. So coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking a little bit on the program today about what to expect over the course of the next few days between now and the end of the year, when mutual funds typically pay out their dividends and capital gains, and some of the things you need to be thinking about. Certainly a good news, bad news situation when it comes to dividends and capital gains, and that is that when you have a good year in the market, generally those dividends, capital gains are going to be a little bit higher than what they may have been otherwise. Particular this year, there's actually about a 30% just in general type of increase over prior year based upon those dividends and capital gains. Now, the reality is that if it's inside of a retirement account, it does not matter. All of that winds up just getting reinvested inside the soup, if you will, because with a retirement account, the only way you pay taxes is if you take money out. As you take money out, you're going to pay at ordinary income tax rates. That's always going to be the case inside of a retirement account. But if you've got an after-tax account, which would be like an individual account, a joint account, a trust account, something like that, then those dividends and capital gains are going to need to be reported on your tax return. Good news on that is that for the most part, dividends, capital gains, taxed at lower rates, so at least that's an advantage, if you will. But the reality is that you really do kind of have a couple of options, if you will, in terms of what to do with them. So let's talk about that potential opportunity or options that you have when it comes to those dividends and capital gains inside your funds, because there are more options than the typical classic reinvestment. I think in most cases folks just reinvest those dividends and capital gains, but we've got a couple of thoughts that you may want to be thinking about in terms of what to do with those dividends and capital gains. So we welcome in our listeners across Central Florida on the variety of radio show networks that we're on. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. Our program here, Dollars and Cents, also one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice. If you got any trouble finding us on those platforms, whether it's Amazon Music or Alexa or Spotify, or there's so many, it's too many to list. The reality is that you can always go to our website, Nelson Financial Planning, and look in the upper right hand corner to click on the icon that looks most familiar to you. You'll get immediately connected to our various channels. Make sure you subscribe to us. That way you know when we upload our program, our podcast, and also our YouTube video. After all, that's the only way you get to see that I am starting to break the holiday ties out of the closet. Then you can get those updates when we post things if you are a subscriber to our various channels. So anyway, we certainly encourage folks to do that, along with what we're talking about on the program today, which is thinking about those dividends and capital gains typically paid out here in December. This conversation really relates to after-tax accounts, individual joint accounts, trust accounts, things like that. So you've got those dividends and capital gains that pay out. More often than not, most people just simply reinvest them. But on the program today, we want to give you a couple of other options to think about. First of all, if you do not reinvest those dividends and capital gains, you may be able to take those and rather than reinvest them, put them in a money market or short-term bond fund or something like that. And the reason why you may want to consider that this year is really twofold. Rather than just simply reinvest them back into the same fund, maybe cross-reinvest them to a money market or a short-term bond fund for really two reasons. First of all, we mentioned that they were higher than last year, which means that your tax bill is also going to be higher than it was last year as a result of that profit for this year in the market. So that means that you may need more money to pay taxes and things like that. So that's number one, a good idea to make sure you got that money on hand, and using those dividends and capital gain that are showing as profit on your tax return that you have to pay taxes on. That's a great way to utilize that money without having to tap into additional cash savings or what have you. So that's number one. Number two is goes to sort of this conversation we've been having a lot over the course of the past many months here on the program, and that is this emphasis on rebalancing. And just to recap what that is, rebalancing is simply bringing your portfolio back in line with the overall investment allocation that you sort of originally had, or maybe originally created, or ultimately wanted when it came to your particular financial situation. So let's say you had an original investment allocation, you wanted it to be growth in income, you wanted it to be 70% stocks, 30% bonds. You set that 2 or 3 years ago and you really haven't checked in on it. Well, what has happened as a result of the market performance over the course of the past 3 years is that 70-30 mix of 2 or 3 years ago probably more like 80-20, maybe even 85-15. And so what's happened is, as the stock piece has gone up in value, the stock portion then makes up a larger portion of your overall portfolio. Hence, you're not out of balance anymore. And the reality of that is that you have a riskier portfolio than what you started out with, except now you're a few years older. So you really want to do that rebalance and on a regular basis, particularly after you've had the kind of run up in the market that we've seen over the course of the past 2 or 3 years. So rebalancing kind of gets you back into that normal sort of allocation that you originally sort of established. The tricky part when you're talking about rebalancing, though, is when you're talking about after-tax accounts. And because an after-tax account, right, if the market's been going up, then if you want to rebalance inside of an after-tax account, like an individual, a joint, or a trust, what happens there is that to rebalance, then it creates a tax consequence, right? You can rebalance all day long inside of a retirement account, and there's absolutely no tax consequences. Try and do that inside of an individual or joint or a trust account. Yeah, there's going to be some tax implications on that. So using the dividends and capital gains as an opportunity to accomplish that rebalance is another great option to use this year in particular, because those dividends and capital gains have gone up a little bit more over prior year. And what that allows you to do is, rather than just simply reinvest them back into the same fund, consider reinvesting them in like a short-term bond fund or a bond fund or a money market, those kinds of more conservative asset classes, because that will help get your portfolio back into balance, number one. And number two, it also means then that you've got a portion of that portfolio that is a little less exposed to volatility going forward. And certainly if you're like any investor over the course of the past few years that has maintained your investment allocation, you're going to find that you're heavier on the stock side these days than when you started. So using the dividends and capital gains, particularly on an after-tax account, is a great way to sort of preserve that profit, to use that profit to help get back into balance in terms of your overall asset allocation, and also maybe to shore up your cash position, particularly if you've got a potential for a higher tax bill next year, or simply, hey, maybe next year, as this COVID stuff starts to diminish even more, that you may want to travel or do something that would require you to use that money. So some important considerations, particularly this time of year, as you get dividends and capital gains and those types of things that will ultimately pay themselves out. Speaking of taxes and how that relates to your investments, I want to take a few moments and talk about the importance of tax diversification, because we often hear about investment diversification, right? The difference between stocks and bonds, and having X% in stocks and Y% in bonds, and that creates your overall investment allocation. And you can go even further than that. Types of companies, large companies, small companies, emerging market companies. On the bond side, it can be government bonds, it can be municipal bonds, it can be corporate bonds, it can be all of that kind of thing. But that only deals with investment allocation. What we want to talk a little bit about on the program today is the importance of tax diversification. So we're going to cover that next here on Dollars and Cents. So stay tuned through the break. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. So before we get to the tax diversification concept, we want to take a moment and tackle the topic that we talked about at the top of the program, and that is this notion of the variety of changes that are happening across pension funds in this country that is a little bit of a disturbing trend, if you will, in when it comes to pension funds and what they're doing today differently than what they used to do. And the reality is that a lot of pension funds, as we know, are underfunded relative to where they should be for the benefits that they have promised to their recipients, right? So think of like GE pension or Kmart pension or California state pension or even the Florida retirement system pension. When you look at those numbers, they don't have the assets on the books necessary to meet all of the obligations that they've promised to their current employees and their current retirees. Now that's important because that could certainly impact the benefits that people are ultimately going to get out of these types of pension funds. And back in May, we talked a little bit about this, particularly with the latest news that came out about the state of Florida's pension plan. And in particular, should I really correct that and say the massive shortfall that the state of Florida pension plan has and still has. And we talked a lot about that on one of our podcasts back in May. Well, we're going to share with you sort of the latest things that pension plans are doing to help to make up these shortfalls. And it's not a particularly great path that they are going down when you kind of hear the details on that. So welcome back to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So make sure you also check us out on our variety of social media channels, podcast channels, and of course, YouTube as well. So to recap the numbers that we shared with you back in May, the Florida retirement system 20 years ago was all in great shape. Running a surplus in fact 20 years ago was over $14 billion. Now, after 2009, right, 2008, 2009, big financial decline, it swung from that $14 trillion surplus to being a $15 billion shortfall. And you may say, wow, that's a pretty significant swing. Understandably, big market decline. But certainly since then, things have gotten better, right? Because like since 2009, except for that little pandemic month where the market went down last year, the market has really kind of been on a pretty steady upward trend since that 2009 period of time. So certainly you would have expected these numbers to have recovered or gotten better, but yet in fact that is not what has happened. Since that shortfall as of 2009 of $15 billion, the shortfall in the Florida retirement system pension plan has only grown to now being $36 billion deficit. So a lot of pension funds are looking at that same issue. State of Florida pension plan is not alone. Most pensions these days are running a deficit in terms of promised benefits versus enough funding. Couple that with what is at the core, 3 additional problems are going to layer in and put additional pressure on these pension funds. First and foremost, our favorite, inflation. Yeah, that's just, you went to get that turkey last week, right? A little bit more expensive than what it had been. Certainly if you were frying it, the oil was a lot more expensive. That's inflation. Number 2, there's a significant increase in the amount of people that are retiring today. We've talked a little bit about that in prior programs. It's like a 50% increase over what the typical trend would be. That is a lot more people retiring. And if you look at some of these states, there's a tremendous amount of employees that are eligible for retiring as a whole. I think a lot of it is because there's just less people that go into maybe government service than before, but also the age of the population that is in those types of jobs can be a significant number depending upon which workforce you're talking about. One of the more alarming statistics on this is that out of Connecticut, if you look at the number of state employees in Connecticut, what you would find is that a full quarter of the entire workforce for the state of Connecticut is eligible to retire between June 2020 and June 2022. So in a 2-year gap, if you will, that we're in the middle of, is the number of people that are eligible to retire from the state of Connecticut as state employees is a quarter of the entire workforce within a 2-year window that we are in the midst of right now. That's a whole lot more retirees, right? And more retirees further put strain on the ability of these pension funds to pay out. Number three, of course, is you got to keep up with returns. And that's probably the biggest part of the problem. Well, I don't know, those other two are pretty big problems. It's just like a three-headed monster, if you will, between inflation and increasing number of retirees. And then lastly, the ability to hit the number. Most pension funds have an assumed rate of return of around 7%. That's a fair assumption, right? Or market over the course of the past 100 years, about 10%. Any type of pension fund is going to have a portion that's in stocks and a portion that's in bonds. So effectively, if they're running like a 70%, 30% type of balance, or maybe even I think like the state of Florida runs closer to 65, 35 of stocks versus cash, bonds, real estate, stuff like that, then you've got that mix, or if you will, or that balance to try and achieve that 7%. But the problem is that for a third of that allocation, that cash and bond piece, there's not much of a return, right? So if I've got a third of my portfolio that's not generating anywhere near what the historical returns would be, then I'm going to be short in terms of my rate of return, and I'm going to be forced into doing things differently in order to make it up. So those are the problems, and here's what is, in our opinion, is going to make those problems even worse, and that is some of the actions that pension plans are taking in order to make up those numbers and deal with these problems. First and foremost is the notion that a lot of pension plans are reducing their cash allocations. It's estimated that cash allocations in pension funds today are at a 7-year low, meaning they've got less cash. I understand, okay? I get it from a rate of return perspective, but cash plays an important part in any investment allocation, whether you're talking about your personal investment allocation or the investment allocation inside a giant big pension plan like the FRS pension plan or the California State pension plan, CalPERS. The other thing that they're doing is that they are using borrowed money. They're leveraging, borrowing money to try and hit the numbers. And with that hand in hand, they're investing more in illiquid alternative investments, whether that's private equity or real estate or whatever the case may be. Those are two significant developments, again, spurred by the three-headed monster of inflation, increasing retirees, and low interest rates on the cash and bond side of things. But I think the actions that they're taking are only increasing the amount of risk that is inside these pension funds. Granted, they may feel like they're forced to do that, but they're taking on more risk. And here's how. Let's talk about that cash issue. So public pension funds today typically hold less than 1% of the entire fund in cash. To make matters worse, pension plans have generally been reducing down their allocation to the bond side as well, from an average allocation of about 33% down to about 24%. The problem is that cash and bonds provide a very important role in any portfolio, and that is that you can use that portion when the market goes down because cash and bonds won't have gone down as much as the stock market. That's the notion of having a balanced portfolio so that you can access certain parts of it when you don't really want to access other parts because those other parts may be down in value. So that's the cash issue. When we come back from the break, we're going to talk about the leverage issue and that problem that is inherent in pension funds today. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So talking today on the program about the issues that face pension plans and pension funds in particular across this country, whether it's the state of Florida's, which is now currently running at a projected shortfall of $36 billion, or whether it's the California or the GE, whatever the case may be, all of these pension funds that have promised benefits to retirees and employees alike are in fact running short relative to the in money relative to the promised benefits that have paid out. We talked in the last segment about the three-headed monster that is sort of exacerbating that. those issues. First, inflation. Second, an increasing amount of retirees. And third, the notion that you've got low interest rates, which makes it very difficult to generate out returns on that cash and bond side of things. And the problem is that when you look at what pension funds have done in response, it doesn't give you a warm and fuzzy feeling, because the reality is that pension funds today hold less cash than they have in 7 years. So less cash position. Also, the average bond position has gone down from being about 33% to 24%. So that's a shrinkage in what you would typically say are the two investments that would be considered the most conservative in any investment allocation that you would want to put together. Because the reality is that if you're a pension fund trying to generate out cash to cover the monthly checks, because those have to be covered by cash, they can't be covered by stock or a bond, they got to be covered by cash in the checking account, so to speak. Then if you shrink down that allocation, you run the risk of further impacting the pension fund, particularly in a tough market. Remember, the purpose of having cash and bonds in any investment allocation is to have some place to go to generate out money that hasn't gone down in value as much as perhaps the stock side did. Let me give you a quote specifically from the recently retired Executive Director and Chief Investment Officer of the State Board of Administration, which actually is the entity that manages the investments for the Florida retirement system. A guy by the name of Ash Williams, he was asked about this question, and his quote is, "The reality is that it is not a problem with an easy solution. Finding a strategy that can accomplish what bonds once did, providing yield in good times and accessible cash in bad, is not a problem with an easy solution. Everybody's wrestling with the same thing." And the problem is that's an issue when it comes to cash and when it comes to those cash allocations and bond allocations. Number two, what's the other issue? The second issue is that you wind up using more leverage and more illiquid investments. So the second issue really has to deal more with like sort of chasing returns, right? If I can't get enough return, I'm going to chase something that maybe it can get me a higher return. We all know that that's a bad idea. From an investment strategy, you don't want to kind of chase something that has done well with the expectation that, oh, that thing that has done well or so much better than what we would have expected, oh, that pattern is going to continue. That's not really what you want to be doing. But the reality is trying to get return in an environment where there isn't much. And so they're looking at pension funds, including like the largest pension fund in America today is actually the California Retirement System Plan. It's called CalPERS. And they just recently voted to increase their exposure to borrowed money. In other words, borrowing money to help goose returns. The problem when you do that is that you are running into an issue if you wind up having any kind of a market decline, because leveraging can increase your loss. It can compound it. Just as it can compound your return, it can also compound your loss. And then the other thing that the folks at CalPERS, in particular most pension plans, are getting more into private equity, which of course is completely illiquid. So the problems are real. Inflation, low interest rates, they're already at a deficit in terms of a lot of these pension funds versus the amount of benefits that they've been offering to pay, in increasing retirees. So not sure that the bottom line is, I don't believe that these pension funds should be running away from the fundamentals of investing. Cash and bonds still play a vital role in any investment allocation. And what concerns me is that these pension funds getting more and more away from that. Ultimately, it's fine when times are good, but it becomes pretty unfine when times aren't. So think of that from a personal investment portfolio. Have you gotten away from cash and bonds? Have you been steering away from that because there's not much of a return? Well, we would encourage you to make sure that you're maintaining an allocation there, because it's fine when times are fine, but it's not when they're not. So make sure you're not steering away too far from having that as a portion of your overall investment allocation. And then lastly, or second, never borrow money to help your return. I'm sorry, I just fundamentally disagree with that, because as a retiree, you should have enough to retire. You shouldn't have to borrow money to leverage to try and use that game, if you will, to try and get a better return. The reality is, have enough money to do it without having to borrow money at the end of the day. Leveraging, not a particularly great idea when it comes to your investments. And then lastly, number 3, the notion of having illiquid investments, that can be very, very difficult. It really is a pretty limiting factor when it comes to your investment strategy. So bottom line is, unfortunately, there's a lot of pension funds that are doing these things, but we would encourage you as an individual investor to make sure you are steering clear of these. That's why we're sharing with you this story of what pension funds are doing, because we think those are bad ideas when it comes to an individual. And so certainly from an individual point of view, cash and bond piece still important. You want to make sure you maintain that. Borrowing to improve your return, never a good idea. And then having a bunch of illiquid stuff that you can't get your hands on, that makes it very difficult to have the liquidity that you're going to need at tax time. So just some thoughts on the current trends in pension funds and what you as an individual investor need to know about what they are doing. Make sure you don't make those same mistakes that I suspect that they are doing, trying to bridge the gap of a return that they just haven't been able to meet. We're going to circle back to something we mentioned earlier in the program in the last couple of minutes of the show here, talking about the importance of tax diversification. We talked a little bit about that. What is it and how does that relate? Well, that's very different than investment allocation. I think these days a lot of people focus on investment allocation, the mix of stocks and bonds, and certainly that is crucially important. But the one thing that you also want to make sure you're sort of layering in on top of that is this notion of tax diversification, because what that means is that you're able, when you get to retirement, to make decisions as to where you're going to take money from without having everything taxed at the highest possible rate. So that's one of those things that you need to be thinking about your tax diversification early on and not just as you hit retirement, because it becomes important to make sure that you've got assets that you can utilize that, okay, fine, yes, you're going to have to pay taxes on those. You're maybe even going to have to take a required minimum distribution on them. Okay, that's one item. But then are there other assets that at the end of the day you can utilize without any limitations and the tax implications are not that significant? And that would be more on the after-tax side of things. So here's the notion of tax diversification in a nutshell. Bottom line, of course, is that the less tax you pay in retirement, well, that means that the more money that you have in your pocket to actually spend, and you're certainly going to want that, well, considering inflation and all those kinds of things. But here's the reality. How do you achieve that tax diversification? First of all, understand the difference in the tax nature of your investments, right? Qualified versus non-qualified. Know where the tax brackets are. When are you going to bump into that next tax bracket? And more importantly, when to take that money. So some final comments or final thoughts on tax diversification on the program. We're going to wrap it on up and get on out of here. Thank you all for joining us here on the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.